So every single day, there's this hidden language that dictates the flow of trillions of dollars globally.
Oh, yeah. Trillions.
Right, and it determines whether businesses survive or fail, or whether your retirement account grows or shrinks. And honestly, it really feels like it is designed specifically so you can't understand it.
I mean, the vocabulary of finance is just incredibly dense. It basically acts as an invisible barrier to entry for everyday people.
Exactly. So today, we are cracking the code. We're doing a deep dive into a narrative guide called Wall Street Academy, a guide to the financial markets.
And what's cool is instead of a dry textbook, we're actually following a protagonist named Marcus Johnson.
Yeah, he's this guy studying for the SIE, right?
The Securities Industry Essentials exam, which is the gateway test for anyone trying to get a license to work in the financial industry.
Right. So by looking at the curriculum through Marcus's eyes, we kind of strip away the intimidation factor. The mission here is to decode this jargon so you can confidently navigate your own financial journey.
And mastering these foundational concepts really is the only way to see the hidden patterns driving the global economy. I mean, once you decode the terminology, you realize the market isn't just like a giant calculator.
Right.
It's this living ecosystem of human behavior, strict rules, and highly engineered incentives.
Okay, let's unpack this. We get to ride shotgun as Marcus sits in Professor Morgan's classroom. And the very first word she writes on the chalkboard is securities.
Which makes total sense as a starting point.
It really does. You can't build a financial portfolio or even have a basic conversation about wealth until you understand the raw materials you're working with. A security is just an investment product.
Right.
And the entire global financial system basically boils down to two fundamental pillars, which are stocks and bonds.
And those two pillars represent the most fundamental choice an investor makes. Do you want to be an owner or do you want to be a lender?
So with stocks, you are an owner. The guide breaks this down into common and preferred stock, right?
Yeah, exactly. Common stock is what most people trade. You buy it, you get a sliver of ownership, and you get voting rights.
Which sounds great.
It is, because if the company invents a revolutionary product
Right.
then you have treasury securities, which is lending money directly to the U.S. government. That's generally considered the safest debt on the planet.
So think of it this way. Buying common stock is like buying a slice of a local bakery. If they invent the next big pastry craze, the value of your slice just explodes.
Right, you get to share in that success.
But buying a corporate bond is just loaning the baker cash to buy a new industrial oven. You don't own the bakery. You don't get a cut of the pastry profits.
Nope. The baker just owes you your initial loan back, plus interest. What's fascinating here is how it balances risk and reward.
How so?
Well, your upside as a lender is strictly capped at whatever interest rate you agreed upon, but your risk is significantly lower because you have a contractual promise to be paid back.
But buying individual bakery stocks or singular corporate bonds requires an immense amount of research, right? And capital.
Oh, absolutely. Which is why the financial industry engineered pooled investments.
Like mutual funds, which Professor Morgan introduces next. They pool money from thousands of everyday investors to buy this massive, diversified basket of stocks and bonds.
Right, so you get instant diversification, though it's really important to understand the mechanics of how you access them.
Like how they're priced.
Yeah, mutual funds are priced only once a day at their net asset value. But if you want the diversification of a mutual fund, but the rapid trading capability of a stock, you use an ETF.
An exchange-traded fund.
Exactly.
Yeah.
It trades all day long on the open market. The Academy also covers UITs, unit investment trusts, which are built a bit differently.
Right. Instead of an actively managed revolving door of stocks, a UIT buys a fixed portfolio and just holds it until a specific maturity date.
And we can't forget REITs, real estate investment trusts. That's for people who want exposure to the real estate market but have absolutely no interest in, fixing a leaky toilet at midnight.
Sign me up for that. You just buy shares in a company that owns and operates income-producing real estate, like shopping malls or apartment complexes. You get the dividends from the rent without actually dealing with the tenants.
Perfect arrangement. So now that we have these building blocks established, we really have to look at capital flow. Like, where are these securities actually born and where do they go to live?
Right. The Academy visualizes this with two separate doors, the primary market and the secondary market.
Yeah, the primary market is all about capital formation. It's where a security is sold for the very first time, like an IPO, an initial public offering.
So the cash goes directly from the investor's pocket into the company's bank account. And the company uses that cash to build factories, hire engineers, whatever they need to do.
But once that first transaction is done, the company steps completely out of the picture. The security moves through the second door into the secondary market.
Which is basically liquidity provision. The New York Stock Exchange, the NASDAQ electronic communication networks.
Exactly. When you buy a share of a tech company on your phone today, you aren't actually giving that tech company any money.
Wait, really? You're just buying it from someone else?
Yep. You are buying it from another investor who decided they wanted to sell. So prices in the secondary market are purely driven by the psychological momentum of supply and demand.
Wow. Which naturally brings up the classic market conditions we always hear about. Bull and bear markets.
Right. Markets use as a memory trick for this. Bull up, bear down.
Simple enough. Bull means prices are charging up. Bear means prices are hibernating or falling down. But Professor Morgan pushes Marcus to look past that surface level stuff.
Yeah, she wants him to understand the invisible structural risks threatening the value of those assets. Market risk is obvious, the general market crashes.
But then there's inflation risk, which is kind of silent. Like if you have a bond paying you 2% a year, but inflation is running at 5%, your investment is mathematically growing.
But your actual purchasing power is being destroyed. You're essentially losing money safely.
Ouch. And then there's credit risk, which is just the danger that the corporation or city you lent money to simply defaults.
Right. There's also liquidity risk. That means you might own a highly valuable asset like a private startup share or a rare piece of real estate, but when you desperately need cash, you just can't find a buyer quickly.
Reinvestment risk is fascinating to me because it's essentially the penalty of success.
Oh, for sure.
You buy a bond paying 8%. It matures, you get all your money back, which is great. But the economy has changed. Now new bonds are only paying 3%.
So you have to reinvest your cash at a much lower rate of return. And that ties directly into the golden rule of fixed income that Marcus circles in his notes. When interest rates rise, bond prices usually fall.
Okay, wait, I need to stop you there and push back on something Professor Morgan teaches regarding systematic versus unsystematic risk.
Okay, what's the hang up?
Well, she tells the class that unsystematic risk affects just one company or one specific industry. Like if a new regulation kills the coal industry, your coal stocks tank.
Right, and the textbook solution to unsystematic risk is diversification. Don't put all your eggs in one basket.
Exactly. But she defines systematic risk as a total market meltdown. If systematic risk affects the entire global system, then diversification doesn't actually save you, does it? I mean, if the whole grid goes down, every single basket gets smashed.
That is exactly right, and it's a crucial point. You cannot diversify away systematic risk. During a massive liquidity crisis like what we saw in 2008, correlations go to 1. Everything drops simultaneously.
Tech, healthcare, real estate, it all just bleeds.
Right. Absolute safety in investing is a mathematical myth. Diversification only insulates you from the isolated implosion of a single company or sector. To survive systematic risk, you simply have to endure it.
Which is terrifying, but it makes sense.
And that's why you need a highly specific portfolio architecture built entirely around your personal timeline.
Which perfectly transitions to the regulatory environment. Because absolute safety is a myth. Financial professionals aren't allowed to just guess what a client needs. They have to actually know you.
Moving from abstract market risks, we have to look at the strict rules governing how Wall Street interacts with you, the individual investor. The Academy dives into KYC, Know Your Customer, and Regulation Best Interest, or Reg BI.
Reg BI is kind of like a doctor prescribing medicine, right? A drug might be perfectly good, but if it doesn't suit your specific symptoms, prescribing it is malpractice.
That's a great way to put it. Reg BI mandates that a broker-dealer must act in the customer's best interest, legally subordinating their own commission incentives.
The guide uses this hypothetical client named Linda. She's 45, married, 2 kids, aiming for retirement income. And it uses her to demonstrate suitability.
Right. If we connect this to the bigger picture, finance isn't just math, it's deeply personal. Your portfolio is essentially a mathematical reflection of your life goals and constraints.
Let's apply Linda's situation to you, the listener. Think about your own 401k or brokerage account right now. Your age, your tax bracket, your risk tolerance, and your time horizon when you actually need the cash. All of that dictates your asset allocation.
Right. If your broker takes your retirement funds and dumps them into the exact same aggressive, highly volatile tech stocks they recommend to a 22-year-old day trader, that isn't just bad advice.
Under Reg BI, it's illegal.
Exactly. It fails the test of suitability.
And your goals also dictate the physical mechanics of the accounts you open. A standard cash account just requires you to pay in full for every security you buy.
But a margin account allows you to use leverage. You literally borrow money from the broker-dealer to buy more securities than you can actually afford.
Which sounds risky.
It is. Leverage multiplies your gains if you were right, but it aggressively multiplies your losses if you're wrong. It can sometimes force you to deposit more cash just to keep the account open.
Then you have estate planning tools like TOD, transfer on death, which allows your portfolio to completely bypass the agonizing probate court process and instantly transfer to your beneficiaries.
Or custodial accounts, where you manage assets for a minor until they reach legal age. And of course, the massive world of tax-advantaged retirement accounts, traditional IRAs versus Roth IRAs.
Oh, the classic debate.
Yeah, the government uses the tax code to incentivize you to lock your money away for decades. The debate between traditional and Roth is entirely a debate about tax timing.
So with a traditional IRA, the government gives you a break today. You deduct your contributions, which lowers this year's tax bill. But decades from now, when you withdraw that money in retirement, the IRS taxes every dollar as ordinary income.
Right, whereas the Roth IRA completely flips the timeline. You get no tax break today, you fund it with after-tax money, but the incentive is massive.
Because all that compounding growth over the decades and all your qualified withdrawals in retirement are completely tax-free.
Exactly. You also have employer-sponsored versions like the 401k, the 403b for nonprofits, and the SEP IRA, which allows small business owners to shield large amounts of income.
Okay, so basic stocks, bonds, and retirement accounts work for most people. But when an advisor knows their customer has highly specific hedging needs or complex income goals, basic tools just aren't enough.
Right. And the Academy narrative shifts here to introduce precision instruments, starting with a deeper look at fixed income mechanics.
Here is where it gets really interesting. Wall Street Academy literally has a character named Mr. Bond walk into the classroom in a dark suit to teach fixed income.
Oh, it is incredibly cheesy.
So cheesy, but honestly, it makes the dense math stick. Mr. Bond breaks down a bond with a par value of $1,000 and a coupon rate of 5%.
Which basically means the issuer promises to pay $50 a year in interest. But we already established that bonds trade on the secondary market and prices fluctuate based on interest rates.
Right.
So what happens when that exact same bond is trading for only $900?
Well, the $50 annual payout never changes. It is locked to the original par value. But because you only paid $900 to buy the bond, your current yield jumps up.
Right, because $50 divided by a $900 investment is a higher percentage return than $50 divided by $1,000.
And this introduces YTM, yield to maturity. This is the true grand total return. If you buy the bond at a discount for $900, you collect that higher current yield every year.
And then when the bond finally matures, the issuer is legally obligated to pay you back the full original $1,000 par value. So you made money on the interest payments, plus a $100 capital gain on the principal.
But the issuer has a defense mechanism, don't they? Called risk.
Oh, yes. If interest rates drop dramatically, the issuer can call the bond back early. They essentially hand you your principal and say, we aren't paying you 5% anymore when we can borrow new money at 2%. Your investment is cut short.
The textbook also categorizes the underlying collateral. A secured bond is backed by hard assets like, if the company fails, they sell the factory to pay you back. A debenture is totally unsecured, backed only by the company's credit score.
And a convertible bond gives you a literal superpower. You can swap your debt for common stock if the company's share price explodes.
These structural nuances really prove that bonds are not just sleepy instruments for retirees. But to see true financial engineering, Marcus moves into the options room.
Options sound like absolute magic to the uninitiated.
They really do.
But at their core, they are just contractual rights. These tools exist not just to gamble, but to manage risk or generate income.
Let's break down call options and put options. An option gives you the right, but not the obligation, to buy or sell a stock at a specific strike price before a specific expiration date. You pay an upfront, non-refundable fee for this right, called the premium.
Right.
So buying a call option, which is the right to buy a stock, is exactly like putting down a non-refundable deposit to lock in the purchase price of a house.
Let's apply that house analogy directly to the market. Say you pay a $500 premium for a call option. That gives you the right to buy 100 shares of tech company X at a strike price of $50 a share anytime in the next 3 months.
Okay, so suddenly tech company X announces a massive AI breakthrough. The stock shoots up to $80 a share on the open market. But because you hold the call option, you get to exercise your right and buy those shares at your locked-in strike price of $50.
You are instantly in the money. You can turn around and sell those shares for $80, pocketing the massive difference.
That is wild. And a put option is the inverse, right?
Yeah, it gives you the right to sell a stock at a specific strike price. Speculators use puts to bet against a company, but massive institutions use them as insurance, known as a protective put.
How does that work?
Well, if you own $1 million of stock and you fear a systematic market crash, you buy put options with a strike price slightly below the current market value. If the market tanks, the value of your stock plummets, but your put option gives you the contractual right to sell your shares at the higher strike price.
Wow, so you have mathematically engineered a floor underneath your portfolio. Options don't just create leverage, they literally manufacture certainty.
Exactly. Wall Street engineers solutions for really complex financial problems.
But anytime you have tools capable of generating millions of dollars in a matter of hours, human greed is going to test the boundaries.
No, inevitably.
This takes markets out of the trading floor and straight into compliance court. And also the economic tower, where the referees of the financial world operate.
Right, the regulatory framework. Because the financial system operates entirely on trust. Without strict policing, the secondary market would just collapse into chaos.
The academy runs through the major compliance violations. Insider trading is obviously the most famous. You learn material, non-public information like a secret merger, and you trade on it before the public finds out.
Then there's churning, which is when a broker maliciously executes excessive trades in a client's account, ignoring their goals, just to rack up massive commission fees for themselves.
But the one that really exposes the mechanics of the market is front running. So what does this all mean? If my broker sees I'm about to buy a massive amount of stock that will drive the price up, and they buy it for themselves first, they are basically stealing my market impact.
That is exactly what they are doing. This raises an important question about the sheer scale of trust required to make global finance work. Front-running is a structural abuse of the order book.
It's parasitic.
It really is. The broker uses their own personal account to buy the stock at the lower price before they execute the client's trade. Then the client's massive order goes through, the price surges, and the broker instantly sells their personal shares for a profit.
Which is precisely why we have a heavily fragmented, multi-layered regulatory system. The SEC, the Securities and Exchange Commission, is the macro-level federal boss. They oversee the entire landscape.
And FINRA, the Financial Industry Regulatory Authority, is the micro-level cop. They regulate the broker-dealers directly, they administer the SIE exam Marcus is taking, and they enforce the rules against churning and front-running.
You also have the MSRB writing rules for the municipal bond market and the OCC clearing all those complex options contracts we just talked about.
And if the worst-case scenario happens and your brokerage firm goes totally bankrupt, SIPC steps in. The Securities Investor Protection Corporation acts like FDIC insurance, but for your investment accounts, recovering your assets if your broker fails.
But regulating the participants is different from controlling the environment they operate in. The final stock on Marcus's tour is the economic tower. The financial markets don't exist in a vacuum. They exist within the weather system of the broader economy.
Right, and the ultimate weather maker is the Federal Reserve. They control monetary policy. By manipulating interest rates and the money supply, the Fed literally controls the cost of capital.
Fiscal policy, on the other hand, is the government itself, like Congress and the president changing tax rates and government spending to stimulate or slow down the economy.
And the health of that economy is tracked by indicators like GDP, measuring total economic output, and CPI, the Consumer Price Index, which tracks inflation.
Professor Morgan ends the class by focusing on one specific, highly predictive indicator, the yield curve. This is a graph that plots the interest rates of short-term government bonds against long-term government bonds.
Under normal conditions, the curve slopes upward. If you lock your money up for 10 years, you demand a higher interest rate than if you lock it up for 2 months.
You take on more time risk, you get more yield. Makes sense.
But the curve can invert.
Which means short-term bonds suddenly pay more than long-term bonds? Why would that ever happen mathematically?
It happens because the massive institutional players in the bond market foresee an economic disaster. They anticipate a severe recession, which means they know the Federal Reserve will be forced to drastically cut interest rates in the future to stimulate the economy.
So investors rush to lock in long-term rates right now before they drop. And that massive demand pushes long-term yields down, inverting the curve. So an inverted yield curve isn't just a chart, it's a crystal ball screaming that a recession is coming.
Exactly. And Marcus realizes the vocabulary of finance isn't just a list of terms to memorize. He reads the motto carved above the academy: know the product, know the customer, know the rules.
Passing the test and succeeding in investing is about understanding the living, breathing financial world those words create, which leads to a fascinating concept dropped right at the very end of the guide: arbitrage.
Ah, yes. Arbitrage is the act of exploiting tiny momentary price differences for the exact same asset across different markets.
Buying a stock for $10 on one exchange, instantly selling it for $10.01 on another, it carries zero risk, but it requires microscopic precision and blinding speed.
It relies entirely on spotting the gap in the system before anyone else.
Which leaves us with this final thought. If the yield curve is effectively a crystal ball for the economy, and arbitrage is the act of exploiting tiny price differences between markets, how much of global wealth is generated simply by those who are fastest at reading the signals and spotting the invisible gaps before the rest of us even know they're there? It really makes you wonder who is actually playing the game and who is just providing the liquidity for the players.